This is the pattern that fools most beginners. It can be falling, looking weak, looking bearish, right before it rips higher. Or it can be climbing, looking strong and healthy, right before it collapses. It's called the wedge, and once you learn to read it, you'll see these breakouts coming before everyone else. Let me show you how to spot it and how to trade it. A wedge is built from two trend lines squeezing together, but here's the twist that sets it apart from a triangle. Both lines slope in the same direction. Let's start with the falling wedge. Price is drifting down. It makes lower highs and lower lows, so both lines point downhill. But the highs are falling faster than the lows. The two lines converge, and price gets pinched into a narrowing channel that tilts down. Here's the story behind it, and it's the whole key. Price is sliding lower, so on the surface it looks like the sellers are firmly in control. But look closer at those lows. Each one is falling slower than the last. The selling is running out of steam. Every push down is weaker than the one before. Buyers are quietly soaking up the pressure, and when that last bit of selling dries up, price snaps out the top of the wedge and runs. Now, how to trade it? 3 simple steps. Step 1. Your entry. You do not buy while price is still inside the wedge. You wait for the breakout. The moment a candle closes above the upper falling line. And it's far more convincing if it breaks out on a spike in volume, because that means real buyers are flooding back in. Step 2. Your target. How far it could go. You measure the height of the wedge at its widest part, the back, where the two lines are furthest apart. Let's say that's $8 tall. Now add that height to the breakout point. If price breaks out at 52, then 52 plus 8 gives you a target of $60. Step 3. Your stop loss. You place it just below the last low inside the wedge, under that lower line, around 49. The logic is clean. If price breaks out, but then falls back inside and slips below the wedge, the pattern has failed and you're out with a small controlled loss. And one tip to sharpen your eye, volume. Like most patterns, a wedge usually goes quiet as it narrows toward the point. Then on a real breakout, volume surges. A break backed by strong volume is far more trustworthy than a quiet one. Now the mirror image, the rising wedge. Flip everything. Price is climbing, making higher highs and higher lows, so both lines slope up. But this time, the highs rise slower than the lows. It looks bullish, but it's actually a warning. The buying is fading, and when the last buyers are exhausted, price breaks down through the lower line. You trade it the same way, just in reverse. You wait for the break below. You measure the wedge's height and project it downward for your target, and your stop goes just above the last high. So remember the simple rule. A falling wedge usually breaks up and a rising wedge usually breaks down. The wedge points one way and price tends to go the other. Now the honest truth, like with every pattern, this is not a guarantee. It's an edge, the odds tilted in your favor. You wait for the break. You set your stop on the far side of the wedge and you let it run toward target. Quick reminder, this is education, not financial advice. Always do your own research. So there it is, the wedge. Two lines squeezing together, sloping the same way. A falling wedge breaks up, a rising wedge breaks down, and your target equals the height of the wedge. Spot it, wait for the break, and trade it with a plan. I'll see you in the next lesson.